Once again, good evening, and welcome to the webinar dedicated to trading strategy, and more specifically to trading style, scalping, day trading, or swing trading. You know there are different trading styles. Scalping, it's a very short term, day trading, or swing trading. For scalping, it's a very short term from some seconds or to some minutes. For day trading, it's quite intraday, within 24 hours. And swing trading, it's medium term, so it can be some days, even 2 weeks. Let's start with scalping. Scalping, you know, it's a very specific trading strategy, a very short term. Here is a profile. You have to be very resistant to stress because it's very stressful. It's a high frequency trading. You also need a high availability and a very high reactivity, because it's high frequency trading, so you are trading direct, staring at your screens. It's very demanding and very hard. It requires a lot of experience. What about the features? The period can be between, as I told you, from some seconds to some minutes, so between 0 to 30 minutes. You will be using 1 minute or 5 minutes chart, and you will be using candlesticks. Target. The target is quite low, but it's totally logical because it's a very short-term strategy. It can be from 2 pips to 20 pips, depending of the chart configuration and the opportunity, but usually it's between 2 and 20 pips. Stop loss and take profit. I know that some scalpers are not using stop loss and take profit because they are watching their orders, staring at their screens. But usually the ratio is around 1.5. It's under 1 to 2, around 1.5. Now about the analyze tools, it's quite restrained. It can be minor supports or resistances and some oscillators. Now I'm moving on my screen. On the other screen, this one, yeah, now I'm showing my MT4 platform normally. Yes, okay. So I'm on the Euro USD with a 1 minute chart, and as you can see, so usually for intraday we are using 4 hours or 1 hour, but you know, even on 1 minute you can define some minor supports and resistances. There's a very good example here. For example, here at 1.2735 there is a resistance. Okay, you can see here it was a support. We finally broke the support, and now it's a resistance. And also you can define a resistance area which is around 1.2715 and 1.2717. No, this area 2 pips wide, that is still a support area. So you know, even on chart using a 1 minute candlestick, you can define some minor supports and resistances. Also oscillators can be useful, especially in a transversal movement. Here, for example, you can see that the stochastic is overbought. So we may expect a bounce below the resistance. Let's see. Anyway, it was just an example on a 1 minute chart, just to show you that it's possible to analyze the chart even on a very short-term trading strategy. Now, to avoid, scalping, as I told you, it's very specific, so you better avoid some environment like extreme volatility. When the volatility is very high, scalping is very risky. That's why you better avoid trading economic news. Also, as it's a high frequency trading, it's spread consuming. So for this reason, you better avoid trading exotic and emerging pair because of the spread, but also because of the volatility. You know that exotics and emergings are very volatile. One pro, two cons. One first advantage: a lot of opportunities all day long. You can spot a lot of opportunities, which is totally logical because it's a very short-term trading strategy. And cons, it's spread consuming. Why? Because of the frequency. You can be trading 20, 50, even 200 position a day. So it's very spread consuming. And the main coin, it's very stressful and time consuming. You know that most of scalpers are professional. They are trading, but it's like a job for them, so they can spend 8 hours, 10 hours trading using this kind of strategy, scalping. So it requires a lot of experience and temper. Now let's talk about day trading. So scalping, a very short-term trading strategy, and day trading, a short-term trading strategy. Usually it's called intraday, so within the day, under 24 hours. The profile, it requires certain availability, some hours a day. Can be 4 hours, 3 hours, maybe 2 hours a day. It requires a good feeling and timing, because you have to feel the timing. You know that the day is full of economic news, can be major or important economic news. So there is a rhythm. You have to adapt your trading to this rhythm, to this economic news. And also it requires a good analyze skills, and you have to master. So it's not so tricky. You just have to master stop loss, take profit, trading stop, and pending orders. But normally, even beginners know how to master this kind of tools: stop loss, take profit, trading stop, and pending orders. What about the features? The period. It's between 1 hour and 24 hours. The chart you can be using 15 minutes, even 1 hour, 15 minutes to 1 hour, and you will be using candlesticks or bar chart, but candlesticks are more useful, I guess. The target, this time is a short-term trading strategy, so your target can be greater, higher, from 20 to 50 pips. So it depends of the chart configuration and it depends of the pair. For example, on Euro USD, for day trading, your target can be around 30 or 40 pips. Okay. Now, excuse me, sorry, just 1 minute. Day trading, yeah. Now, what about the risk ratio? Stop loss and take profit. Usually for day trading, it's around 2.5. 1 to 2.5. Obviously, it depends of the chart configuration, depends of your behavior. If you're aggressive, it can be less than 2, but usually it's 1 to 2.5. And analyze tools, you can be using major supports and resistances, moving average, and oscillators. A very wide panels of tools anyway. To avoid, so using day trading, you better avoid very low volatility, because by using day trading you are expecting to reach your target, which is around between 2 and 50 pips. So if there is no volatility, it will be very difficult for you to reach your target. But also you have to avoid very high volatility. So you have to avoid major economic news. Sometimes it can be too volatile, so too risky. And also you better avoid exotic pairs because of their volatility and their wide spread. But on day trading, you can be trading emerging pairs. It's on day trading. It's possible. It's not so risky. Pros and cons. 2 pros, 1 con. So with day trading, you can spot some opportunities in a day. It doesn't require a big capital. And the main con, it requires an availability of at least 2 hours. It's a minimum because you have to define an intraday strategy. So usually you have to spend 1 hour in the morning and 1 hour during the day to watch your position, your orders. So 1 hour to define your trading plan, your trading strategy, and 1 hour to watch your orders and positions. And now swing trading. So here is the profile. It doesn't require very big availability, between 1 and 2 hours a day. Usually swing traders are spending 2 or 3 hours to define their strategy for the week, and then every day they used to spend 1 hour just to watch their orders. That's it. It requires a good ability to feel the trends, because when you're a swing trader, you are trading the trend, bullish, bearish trend. And also, now it's obvious, you have to master sell stop, take profit, trailing stop, and pending orders. Features. The period is quite wide, from 2 days to 14 days. So it's not a rule, but usually it's between 2 and 14 days. So it's not a short-term trading strategy, but medium. What about the chart? For swing trading, you will be using 4 hours or daily candlesticks, and you can be using candlesticks or lines. Why lines? Because it can be useful to use lines to spot a pattern. You know, for swing trading, patterns are very important. They can give you some signals: bearish, bullish signal, or flattish signal. So lines can be useful to spot patterns. The target, once again, the target is wider, from 50 to 150 pips. Once again, it depends on the chart configuration and depends on the pair. And the risk ratio between the risk and the potential profit, it's over 3, 1 to 3. And what about the analyze tools? So, you know, for swing trading, you have to master all analyze tools. Can be major supports, resistances, oscillators, moving average, even Ishimoku. Ishimoku is very interesting analyze tool if you are trading on trends. To avoid, first of all, you better avoid low volatility, once again because your target is quite wide, between 50 and 150 pips. You better avoid anticipating trading reversal. You know, when you are a swing trader, you are like a surfer. You are waiting for the good wave. You have to wait the good opportunity, and once you are sure it's a good opportunity, you can enter on the market. So don't try to anticipate trend reversal, because it can be dangerous. Like for surfer, wait for a good wave. You know, the wave in trading, this is a trend. And try to avoid improvising your strategy. So by the beginning of the week, you better define a very rigorous, very objective trading plan to define your strategy, define your targets and stop loss, etc. Pros and cons, 3 pros and 2 cons. Obviously, swing trading is not so spread consuming because it's a medium term, so the frequency is not so high, and also it allows you to trade exotics and emerging pairs, and even all CFDs, by the way. It's not time consuming. Actually, it's time consuming at the beginning of the week. Okay, when you are to define your strategy, define your trading plan, it's time consuming, but then day after day it's not so time consuming. Just have to watch 1 hour or even 30 minutes a day your orders. And to cons, few opportunities, so you better hide and wait. Hide and wait the good wave, hide and wait the good trend. And also it requires an extensive skills, extensive analyze skills, because by using swing trading you have to master all analyze tools. That's why. So I just define 3 trading styles: scalping, very short term; day trading, short term; and swing trading, medium term. So now here's an extra, a bonus. It's a position trading, which is a long-term strategy. Just a bonus, just an example. It's a very long-term or very long-term. It can be some months. Long-term investment usually are on gold. Okay, you know, when you are trading on gold, and for a long term, gold can be a good coverage. And also it can be a good strategy if you want to cover your exposure. A good example with airlines. You know that kerosene, fuel for airlines are a big part of their expenses. So those airlines are using position trading to cover their exposure. So usually airlines buy oil on the market, to compensate their expenses. And can be the same thing for jewelry. Usually jewelry are buying gold once again to compensate and cover their expenses. It can be the same thing for exporting companies. So here is the conclusion. First of all, you have to choose a style, a trading style adapted to your temperament. If you are an aggressive trader, maybe you better use scalping. If you don't like to take so much risk, on the contrary, you better choose swing trading. And if you are, I would say, balanced, maybe day trading can be adapted to your temperament. Also, respect your trading strategy. Once you find your style, your trading style, you have to define your trading strategy and respect it. Okay. I'm insisting on this point because I know that some traders are listening to their emotions, so it can be very harmful for their strategy. That's why I'm insisting on this point. Respect your trading plan. Okay, so next webinar, next Tuesday, so the 28th of October, next Tuesday, same times, 5:30 for some of you, or 6:30 for others. And next Tuesday, the webinar is dedicated to Fibonacci. You will learn how to trade with Fibonacci retracements, and those retracements are very useful because it's a very interesting tool if you want to define resistance and support levels. Now, if you have any question, don't hesitate to send your question to the chat.